Right, it's 9:30. Good morning, everybody. I hope you had a lovely breakfast and are now ready for today's Accountant's Tax Toolkit webinar. My name is Paul Davison. For those who don't know me, I'm the Director of Business Taxes at PD Tax Consultants. And today I'm broadcasting to you live from Leeds in West Yorkshire, which is where we're based. I've been a tax professional for quite a long time, as you can see there. So I've got plenty of experience in tax, and today I'm assisted by my colleague Amy, who'll be helping out later with the poll and with the questions. As usual, the type of thing is these slides do not constitute advice to you or your clients, so please bear that in mind. Just a little bit about PD Tax Consultants before we begin. It does what it says on the tin. We're a firm of tax advisors. We don't provide any accountancy advice to our clients. It's mainly tax advice and investigations. We do a bit of compliance, but as you can appreciate, a lot of our clients, a lot of our referrals come from accountants, local firms of accountants such as yourselves, hence why we're doing the webinar today. So that's the introductions. A little bit of housekeeping about today's session. We're going to finish on time at 10 o'clock. So we'll be sharp with that. Please send any questions that you get as soon as you can into the Q&A box. There's over 60 participants in the webinar today, so that could be a lot of questions. So the quicker you get your questions in, the more chance there is for them to be fielded at the end. But don't worry, because if you raise a question and it's not answered, we will get back to you after the webinar about that question. And in fact, some of your questions might form the basis for the next Tax Toolkit webinar, which will be later in the summer. Also, there's a poll in the middle of today's session, so get ready for that. The nature of the webinar, well, really trying to keep it as broad brush as possible, as sharp as possible. We've got a number of tips, hints, and pitfalls to get through today, really. So like 9 or 10 of those to get through. I'm going to be as succinct as possible with those topics, because I'm sure you've all got busy days ahead of you. You might, because I'm going to be succinct, you might not fully understand all the points to your liking. And in fact, you might not agree with them all, although there's nothing too controversial. But what we're hoping for really is that at least one of those topics we raise may tweak something in your brain and think about one of your clients or something you've done in the past, or create opportunities, and then you can deal with that as you feel appropriate. We are recording the webinar, so you don't have to take notes. It will be downloaded onto our YouTube channel in due course. So that's all the housekeeping doing. On to the first tax topic, which is an old chestnut, the employee related security returns. This used to be called Form 42 a few years ago. So these returns are due, the 1920 returns are due on or before the 6th of July. And the reason for raising this is that the returns might cover more issues than you think. Obviously, the return is required if a share is issued to an employee, but it also might cover a situation whereby a director or shareholder inserts a holdco above a trading company, as an example, and that director or shareholder receives shares in his own company effectively. We believe that should be covered with an employment-related securities return. Also a situation whereby an employee or a director gets shares in another company, then that situation is also requires an employee-related security return for the company, for the employee company, not the other company. There's a couple of things to think about there. Obviously, if you've done one of these, you know it's a fiddly process, so you need to start getting that set up as soon as possible. Another something else we came across recently. This relates to R&D costs that are capitalized. So if a company capitalizes R&D expenditure onto its balance sheet because of accounting policies, then the tax rules are that you can still claim the full benefit of an R&D tax credit through the tax return form. And that rule changed about 10 years or so ago, and the legislation there is section 1308 CTA 2009. Now, if you do spot this point and you do claim R&D tax credits, there's a couple of things to think about. The first point is that if the capitalized R&D expenditure is then amortized to the P&L account, then it follows that you must add back that amortization in the tax computations. Something to think about. Also, if you do claim the enhanced expenditure, i.e. the making profits and not the credit, please just bear in mind that the enhancement will go through your tax return form, but you've also got to bear in mind to take the actual expenditure from the balance sheet and put that through the CT comp as well. I had a case recently whereby the accountant forgot to put the actual expenditure itself through the CT computation, and the client missed out on a lot of tax relief. Okay, next topic. Clearance requests for insertion of a holding company. More and more we're finding people are putting holding companies in above trading companies as a way to protect assets, but also to manage dividends, especially if there's more than one shareholder in the trading company. If you're going to do this, you've got to be careful with the rationale that you use to HMRC on the clearance request, because a reason for managing dividends out of the trading company is not seen as a commercial purpose for the business, and you won't get clearance. So when you're doing this, you need to consider the commercial reasons, which could be along the following lines: protection of commercial assets, acquisition of assets, establishing a group, facilitating a demerger. Clearly, every situation is different, and there could be other issues, but it's got to be a commercial issue for the company itself, not for the shareholders. Okay, next slide. How to get money out of an investment, out of a trading company into an investment company. So the trading company is generating cash, but you want to use that, the shareholders want to use that cash to buy property, shares, invest in effectively. If you use an investment company that's the side of the trading company, you can have some problems with loans, because the only way of getting the money to the investment company is via a loan. That can cause you significant problems down the line. If you put a investment company above the trading company, that's going to give you issues with entrepreneurs relief and selling in the future. So we've been dealing with some of our clients recently in terms of structuring it so the investment company is given restricted shares in the trading company. Those restricted shares are shares over dividends, and so rights over dividends and rights over votes, but not rights over capital. So that allows you to move the cash up to the investment company tax-free, but it also allows the client to sell their business down the line at 10% without any group issues going on. One to think about for any people who've got some cash in the company and want to start investing it. So now we're on to the poll, halfway through the technical session, and the poll results will be released on LinkedIn and YouTube. Anybody voting in the poll, which hopefully you all will do, will be entered into a prize draw to win a free tax sounding board consultation with myself or my colleague, Vicky Elliott. Our tax sounding board sessions are £25 plus VAT for a 15-minute phone conversation. And if you'd like to expand on the content of your answer to the poll question, please put that in the chat box. We'd really like that, because that will give us some more detail about what people are experiencing. So here's the poll. It's going to launch the poll now. So the questions are, oh sorry, no, I was going to end polling. Sorry, I've got ahead of myself there. Yeah, here's the question. What correspondence have you had with HMRC during lockdown about private share valuations of trading companies? Is it 1, no correspondence; 2, some but without any conclusion or views from HMRC? Is it 3, some correspondence and HMRC have been reasonable in accepting that valuations are materially affected by COVID? Or 4, some correspondence and HMRC have been unreasonable in accepting a valuation is material reduced for COVID? So I'm going to launch the poll now, relaunch the polling. And please make your votes. You've got 30 seconds, by the way, to cast your votes and make and add your comments. Okay, that's the end of the polling. So I'm going to reshare my screen. Thank you for your answers and for your poll. And as I say, the results will be available on LinkedIn and YouTube. So moving on quite swiftly, time's pressing. Talking about just briefly on VAT and property, HMRC have increased the time limit for option to tax. That's used to be, so the key here really is that you have to evidence the fact that you've made a decision to opt to tax, and that could be evidenced in writing in a form, or it could be through evidence that you've acted in such a way. And HMRC have extended the time to notify them of the decision to 90 days from the decision rather than 30 days. But the key really is to evidence the fact that you have made the decision. That's the key thing. Obviously, it's very important to notify HMRC, but if you've evidenced it, you should be okay. If you've got any VAT property issues, please send us a question. We did have a very recent VAT property issue when we had a client who transferred a pub to to somebody else, to a company, and the arrangement there was that the residential part of the pub, i.e. the flat above it, was sort of worth 10% of the overall value, and that had knock-on consequences in terms of VAT and exemptions. And I think the 10% is seen to be sort of an industry standard. So, next topic, quite a simple topic. Try and make it as clear as possible. So when we've got an investment company whose shares are going to be subject to IHT, so we've got a company that's got property or shares or whatever, and it's owned by husband and wife. A little trick here is to make sure that each of the husband and wife have a different class of share. Those shares may well be pari passu, but there must be a different class of share. The reason for that is that it helps with IHT planning when the first one passes away. So when the first one passes away, their shares will go to the remaining spouse, and if you have a different class of share, that class of share can then be passed immediately by the receiving spouse to the children without any capital gains tax. If you don't have any different class of share, then the CGT are moving those shares down to the children. So it's a very simple thing, but it could save a lot of money down the line for your clients. Okay, another issue is where we have, say, a startup company, a tech company, where they've received a round of EIS investment. Obviously, EI investment, to some respect, creates a market value for those. Well, it creates a value for those shares. But if then the company wants to give some shares to an employee after the EIS round, how does that affect the share value for the employee? Because we generally want the employee to receive a low value for the shares, as it provides a better tax position for them. Well, I think the key there is really that, you know, the EIS market can affect the general share valuation, but it's only one aspect of a valuation in terms of employees. Clearly, the investors for EIS are of a different nature to the employees. They have potentially more money. They potentially get much better tax breaks for it. They're not bought into the company like the employees are. So when you're doing a evaluation for employees, I think go through normal methodology, price earnings basis, etc., balance sheet value. Do account for the EIS value, but it's only going to be possibly a relatively small impact on the overall value. Every case is different, but don't take the EIS value as being read. So, use of home as office. This is all pretty relevant to everybody at the moment, as you can appreciate. So if you have a client that's a company, can't just make an allowance for the use of home as office through the P&L account. What you have to do is you have to arrange it so that the company pays rent to the individual shareholder or director for the use of the room. I tend to suggest using a rental agreement for this, just to make sure it's all stacks up properly, and obviously to work out what the market rent is. The benefits of this is that obviously the company gets a tax deduction for the rent, and the individual does have to put the rent on their personal tax return form, but they do get to offset personal costs against that rental receipts, reducing their tax rate on the rent. Oh, if that's too complicated, you can just use a £26 per month expenses claim, which is the round figure, which they can claim as expenses and pay themselves. Another key point, just a simple point on benefits, etc. Don't forget the £50 gift to staff. I think at the moment, obviously, you know, staff are stuck at home. Some are working now, but obviously still a lot of staff stuck at home. Life's a bit more difficult. You can give 50 quid to the staff and gift vouchers with no tax implications, as long as it doesn't become part of their remuneration. And finally, the last topic for today is review shareholdings for Entrepreneurs Relief. So we all know that Entrepreneurs Relief was reduced in terms of its lifetime limit from 10 million to 2 million, well, to 1 million, sorry. But if you do bring in the other spouse as a shareholder of that company, that family trading company, then you've de facto created a £2 million lifetime allowance for the family. So given the reduction in the allowance, it's obviously more important to get it, but it's still a very important tax. And if a company comes and says, I want to sell my company, I've got a buyer, and we've not checked the entrepreneur's relief qualification for a year or 2 or 3 years, then they won't be happy if the outcome is that actually they don't qualify. And there are tricks, there are some pitfalls with this. Obviously it's relatively straightforward. Each spouse must hold more than 5% and must be a director or employee. If there's a non-working spouse, then that person could be a company secretary, and that should still qualify as an officer of the company. But it's very important to review this on a regular basis, perhaps even yearly, because there's always that thought in your mind, does it qualify? Does it qualify? Okay, so that's the end of the tax technical issues today. Amy, are you there? Do you have any questions for us today from the participants?
Yeah, so thank you, Paul. I've got quite a few questions, so I'm just going to pick out the main themes, and then any others unanswered, you can email. So the first question was, if there are 2 classes of shares pari passu, does the fact they are pari passu mean they can't pay different levels of dividend on each share?
Interesting question. The term pari passu means that they have the same power, i.e. what we'd have with the situation I mentioned is you'd have the A class and the B class, and the A class would have rights to capital, dividends and votes, and the B class would have rights to capital, dividends and votes. But because they're in different classes, you can pay differential dividends to them. So you could pay £1 a share on the A class, you could pay £2 a share on the B class. Not really a problem in terms of income tax because it's sort of a family thing. So not really looking at whether it constitutes remuneration. I think one thing to bear in mind is that it probably, just to be on the safe side, in terms of differentiating the classes and achieving the result that you want for the IHT planning, I'd be tempted probably to give one of the classes sort of rights to chairmanship. So even though the rights are almost the same, they're not quite. So HMRC couldn't say they should be pooled. So we might say the B class shares have the rights to appoint a chairman, and that's going to give you a definitive slight differential in the rights, but it's going to make sure that they're both, it's not pooled. Hopefully that's helpful. Amy?
This is also about the trading investment companies. Why not write off the loan between the trading and investment company via connected loan?
Well, that is an interesting question and something I've pored over in the past. And the problem with that is that you could end up with a distribution. So if you lend across and that loan and the trading companies, sorry, the investment companies, the loan is put across, the investment company can repay the loan because of the situation. So the loan is still worth £1 in every £1 you lend. You write that loan off, then that could be treated as being a distribution in the hands of the shareholders. If the loan is not worth, if circumstances mean that the loan is now not worth anything, then it's okay to write off the loan. But if the loan has value and you write it off, I think there is an analysis that says the shareholders could be subject to the receipt of a dividend to that number. It's quite a tricky analysis to go through, but that's our view on that situation, and we don't really want that to put the client in that risk. We'd rather do it the way that we're suggesting.
Also on similar topic. How will a holding company get entrepreneurs relief, as it's not a trading company but holds 100% shares of a trading company?
I could just repeat that question. You were breaking up a little bit.
How will a holding company get entrepreneurs relief, as it's not a trading company but holds 100% shares of a trading company?
I'll answer the question as it's asked. We might need to get back to this person in a bit more detail, but on the face of the question, a holding company can qualify for entrepreneurs relief because there's two different types of companies that can qualify for entrepreneurs relief. The second type is the holding company of a trading group. Now that can qualify for entrepreneurs relief. But if the holding company, if all it does is hold shares in a trading company, that's going to qualify. If the top company starts to make investments, i.e. it starts to buy investments in properties or whatever, then that could mean that taints the group overall and means that it's not a trading group and therefore wouldn't qualify for entrepreneurs relief. If the person who's asking the question is referring to the planning where we own shares where the investment company owns restricted shares in the trading company, then we don't want to sell the shares in the investment company. We want to sell the shares in the trading company that still exist. So with the planning, we've got existing full shares that are owned by the individual in the trading company. They're still there, but we've got some restricted shares owned by an investment company. When we come to sell, we're not selling the investment company shares, we're selling the existing full shares of the entrepreneurs relief and secure the sale. Hope that's helpful. Amy, one last question. I think it's 2 minutes too, so just time for one more question.
Okay, again regarding entrepreneurs relief, if there are different share classes, should qualifying shareholders hold more than 5% of all classes of shares?
Definitely. There's a number of different tests here, and the bottom line is going to be the 5% of the actual nominal capital. So if you might have some restricted shares, you might have some preference shares. You've got to have 5% of the total share capital, even including these restricted shares. So it's the actual nominal share capital you have to have 5% or more of. You also have to have 5% or more of the votes, and there's also tests about if it's wound up and that type of thing. So yeah, it's a good point. You've got to be very careful about what constitutes 5%. Got to go through that with a fine-tooth comb to make sure that you do qualify. They were useful answers. We will, for people who ask questions and that we haven't dealt with, we will respond to you in due course, and we will bear in mind your questions and your comments for the next Tax Toolkit seminar, which will be on the 7th of August at 9:30. There'll be a bit there about divorce and mergers, so please log into that. Please, if you would, link to us on LinkedIn and YouTube, and hope you have a great day. That's the end of the seminar. Thank you very much.